Recording in progress.
All right, good morning, everybody. So the first thing we want to do is get an idea of what happened in the overnight hours, while at the same time getting a little bit of a feel for what we have in store on today's trading session. It often starts with what do we have in the economic calendar. It's jobs day. We have a lot of different job reports coming in. We have some pre-scheduled FOMC speakers, which generally means they're at some kind of conference or something like that. You always want to check the details when it's something that's been in the books for a while, because these can be pre-recorded. And if they're pre-recorded, then there's not going to be any Q&A. There won't really be an opportunity for a Fed member to shock and awe or play the plunge protection team card or anything like that, right? Because it's recorded. So always look a little bit deeper if you see an FOMC member on the books. It's the ones that show up that weren't on the books that should make you a little nervous. So I like to start with Finance Juice. It has this little excerpt written up after 3 market closes: ours, Asia, and Europe. Now technically Europe's not closed yet, but they know that America's waking up. We're kind of looking around, so they put this one in early. But after our market close, you can go in and see our market wrap. It often gives you an idea of maybe what happened through the day and why price might have done something you weren't expecting. And if you scroll back far enough, you can get to Asia's and get an idea of what's going on over there. If they were closed for a holiday, if they are having some kind of national debt crisis, anything like that. And there is this continuing situation going on over there with the real estate and people not paying back or not paying their I don't know, their loan or mortgage, because they're not getting the building that they had ordered or bought. And it all comes down to this huge financial mess that was supposed to be a contagion risk of 2022, but that all went out the window when Russia invaded Ukraine. This whole situation in China became like a backseat to a more immediate problem. Now we've got a currency crisis going on over in Europe, and that is more pressing or front running the whole Russia situation. So the amount of things that are going on in the world that are putting our market in the brink of absolute collapse and ruin, I mean, those things are stacking up. So it's a good idea to take a look around the world, see if they're on holiday or not, if they're in, if their parliament's in session, if there's any bank speakers from around the world that are coming out with any kind of policy changes, rate hikes, anything. I remember when I was new, it never really dawned on me, although it makes perfect sense, that other nations have the same thing, right? They have job numbers, they have unemployment, they have housing, the same econ. And very often the same whiplash or drastic price moves after their econ is reported, just like us. Makes perfect sense, right? So as you can see here on the side, there are a lot of Fed speakers on deck. Speaking of Fed speakers, we've been seeing an unwind from a potential 75 basis point rate hike to a 50 basis point rate hike until yesterday afternoon. So this was turning, and a 50 basis point rate hike was the dominant, and now it's back to 75. This is a pretty radical change from where we were yesterday. So 75 is now not only back on the table, but dominant for the November 2. And if you think about if we did get that 3.75, and then you look at December, going from 3.75 to 4, that'd be a 25 basis point, or to 425, that'd be a 50 basis point. So it looks like they're pricing in a 75 for the November 2, and then a 50 for the December 14 at the moment. But we were unwinding 25 basis points, and generally that would be a little bit of a move to the upside, right? It wouldn't cause our market to go up, but it would take some of the weight off and allow our market to go up. And it's really a better way to look at it, right? Because it's not like it's pushing our market in one direction or another. All right, if you haven't heard yet, the global marketplace nearly was destroyed this week. Way worse than the 07-08 Lehman Brothers crisis, global, that whole thing, and nothing on what was going on so far this week. And everything pulled back from the brink of disaster, amazingly enough. It's a temporary fix, but the longer they have to fix it, the more likely it is that they're going to fix it. So today we have additional auctions, and I want to remind you that you can find these auctions when they come out if you're watching Finance Juice. And one of the reasons that you might want to watch Finance Juice when these come out is to see who's actually standing up to buy our debt. Twice this week, when the reports came out, it said $0 billion or $0 million. Nobody bought it. Yesterday, I looked at the 7-year. Remember, we had a 7-year auction. $0 million. Nobody bought it. The day before, same thing. Well, now we're in the front. Right? We've been dealing with some higher auctions. Now these are really in the front end of the curve. 4 weeks, 3 month. I mean, we're right up front. And we're right there where we could see a little bit of volatility today. So remember, watch the clock. I know these auctions don't get the attention anywhere else that I give it. Maybe I'm the only one that cares, but they radically can reshape our entire trading day. Some of the best midday reversals that I've ever traded came because I knew that there was an auction that day and was waiting for an outcome. This is the VIX curve at the moment. As you can see, we are still in backwardation. If we were in contango, which is just really fancy bank speak, then it should be running from the lower left to the upper right, and instead we're running from the upper left to the lower right. Right? A curve of money and time should start low and generally get higher as you go. Whether it's a yield curve or bonds or VIX or anything that has time and money connected to it. Even the price of an option, right? Options really close to expiration are very cheap, and the farther out in expiration you go, the more expensive they are. They as well have a curve, right? Just like that. Backwardation in contango. So keep your eye on the VIX, even though the market did have that nice little run up off of the lows yesterday. It was kind of due anyways, right? The 5-bar rule at the very least. And looking at the VIX, it shows that it didn't change a thing. All right. We're looking at 231 on the volume this morning, much lower than what we had yesterday. Back into a normal range or a normal level, and that's really all we need out of this thing, so we just get that out of the way. We are inside day at the moment, having sold off through the kill zone. We've crossed through the floor pivot, so we don't have an MDP to worry about. One thing that gets my attention here is that we retraced 50% of yesterday's price action. If you haven't heard me talk about this before, when you have a good sized candle, you can often measure that candle and use it to plot forward projections, right? Just regular price action, technical analysis and measurements. You can measure head and shoulders, wedges, ranges, but you can also measure candles. Now, looking at yesterday, I wouldn't have considered it a very large candle, but it is still a candle that can be measured. So once you've measured it, one of the benchmarks on that measurement would be 50%. It's a standard common number to focus on. And that's how far the retrace came today. Right, we pulled back about half of that candle. And that would pretty much be a benchmark, right? If we were wanting to maintain our bullish posture from yesterday, you really wouldn't want it to pull back more than, say, a quarter of that entire candle. But 50% has to be a line in the sand, right? Now, once you've measured that candle, of course, you can plot it out, giving projections. Like that right there. And of course, this is really hard to see, right? It's really sloppy. There's a lot of junk going on there. So one thing you can do is turn price into a line for a minute. Just kind of hide everything else momentarily. Of course, turning off all the indicators would work too. But there's the price levels for the measured candle. 37.66, 37.83, 38.20, and 38.90 for upside moves. 35.98, 35.80, 35.43, and 34.74 for the downside moves. The really good thing about doing a measurement like that is you know that we can't stay here, right? No matter what else is going on, the one promise that the market is going to give is we're not going to stay where we're at. That's a given, it's a guarantee. So if we do break to the upside, you got your levels, and if we do break to the downside, you got your levels, and you don't have to guess or assume or think you know which way we're going to go in the meantime. You can just let it break outside of yesterday's price action and trade it to the levels. And of course, if we're heading in the right direction anyways, you may as well trade it up there. The ADR is 2.45, so it's starting to decline a little bit after accelerating up above 2.5 for a while. So we're on the decline. ADR is a measurement of volatility. Volatility is a measurement of movement, right? It's just a nerd word for movement. So if the ADR is declining, that means volatility is declining, and that means the movement is declining. So our price action from day to day, from the highest point of the day to the lowest point of the day, is decreasing. That's a good thing, by the way. It means price is settling down a little bit and becoming less erratic. And that makes sense, right? Because we've had multiple days in a row where we really didn't go anywhere. Now, looking at our current situation, we're still sitting right where we were Friday. Talking about not going anywhere. We haven't gone anywhere. There is the JP Morgan collar still sitting at 35.80, and there are still a lot of very smart people who say that's where we're going to end up by the end of the week. Tier 1 from Gamma, they called 36, what was that number? They called a low that we missed by like 6 points. I think maybe they called 36 flat and we went down to like 36.13, something like that. But they were calling it on the SPX, and of course we're looking at the ES, so they're going to be a few dollar differences anyways. So there's still a Gamma structure below us. There's still that JP Morgan collar below us, or yeah, I believe it's still a collar. So there's still that. 35.80. Yesterday was a very viable option, right? We were down close to 36 flat, so going to 35.80 when we're already at 36, yeah, that's totally doable. We're a long ways away from that now, right? We're 120 points plus some. So it doesn't mean that we can't get there, but look at our current ADR, it's 90 points. So we would take that ADR, cut it in half, and then apply it to the ADR, right? So take 90, cut it in half, it's 45. 90 and 45, it's 135. 135 points from our current location. Hey, that puts us right down there in that JP Morgan collar. Imagine that. Now, it's not arbitrary that I took that ADR and doubled it or cut it in half and applied it. I've done that multiple times. It's how we measure extreme, right? Because if ADR is normal and we want to know what's above and beyond normal, that's how we would get there. So it's not off the table yet. 35.80 is well within our reach. I was skeptical last night when we went into the close that it would still be in our reach, but we're quite a ways off from the close. So now it is back on the table. I'm not saying we're going down, but I will mention a few things that aren't necessarily related to some form of technical analysis. We're still here. We're still at these lows. And I bring that up because if you look, say, after Jackson Hole, you guys remember Jackson Hole, right? The mic drop moment when Powell had on the pimp glasses. Supposed to give a 30-minute speech, dropped the mic after 8 minutes and walked the floor. Dumped the market down. Or back here, after we had the FOMC and the March rally and then everything just flipped over and we came down dumping like a mad demon. And here as well, it never even slowed down at the pivot point, just kept on going. Now, some of these consolidation periods ended with a rally back up. This particular rally happened to be an FOMC meeting in March. Other times when we based and collected and consolidated as we are here, and maybe a little bit wider, but it still continued the next leg lower. It just took about a week or so. Even here, with nearly 5 days of sideways price action, we had a small bump to the upside before another hard, fast liquidation breakdown. So if you haven't heard me say it before, the longer we stay consolidated and sideways, the more energy we build up. And we learned that a market does this by using that indicator fractal, the RSI Laguerre or Laguerre fractals, that a market builds energy. And there's a couple of ways that it can build energy. It can quickly reverse, that'll build energy, or it can base and consolidate. And energy is not really a word that we normally associate with the market, right? We talk about inertia and momentum and trend, but energy, as applied by those fractals, has shown us that the longer we base and consolidate in a particular spot, the more energy we build. So then when a market does begin to make a move, you can ask the question, is it making a move to gain energy, or is it making a move with energy behind it? And the analogy for that would be if you throw a ball to your friend. You put energy behind the ball, you throw the ball. As the ball moves, it loses energy. And if your friend doesn't catch it in time, it hits the ground because it ran out of energy. Drop a ball off of a very tall building. the more it falls, the more energy it picks up. Well, the same thing with the market. We want to be able to answer that same question. Are we moving with energy, or are we moving to get energy? In this case, we're holding steady, building energy, so when the move does come, it's going to be with energy behind it. Now, that doesn't imply what direction we're going to go, just that the longer we stay here winding up, the more energy we're going to have. But we are still here. We've held. If the crazy drastic situation from earlier in this week was to have happened, we would be sitting somewhere around 22 or 23. And obviously we're not there. Five-day bar rule kind of gave us a little bit of a bump yesterday, but it wasn't sustainable at this point. It didn't stick. So an upside move today, if we do start to get positive again, we would first need to break through 37.30. It'd be the open from last night. The high of yesterday at 37.50. The weekly pivot point at 37.70. And then the ADR at 37.75. A full ADR at 38.21. There is a cog line at 38.11. So I'd add that in there too. All right, so we're looking at a 10-day, 30-minute volume profile. On the right-hand side, we also have TPO. It's time, price, opportunity. Think of these two as volume by time and volume by price. And most of the time, when you look at them combined, you can spot, say, an unusually large pool of volume that we might have landed into and then moved away from very quickly. So that's one of the reasons that I run them in a pair like this. Now at the moment, like we've talked about earlier in the week, we had a significant level of volume around that 3,700 area. And we managed to get through it yesterday without as much struggle as I expected there to be, which is pretty cool, right? Normally we move, like yesterday afternoon, we move that way in a shallow area, not through an area with a lot of trash and debris like we have here. Either way, we made it through it, and now we're right back down into it. And the longer we stay in this zone now between 37.40 and 36.80, or maybe even 36.30, I think that'd be a better number, then we're just going to continue to build this out more and more until eventually that point of control comes down here. Now, I don't think we're going to stay here that long. But like we were just looking at on the daily chart, at numerous times this year, we've set a range like we are in right now for more than a week. All right, so we could stay here for the rest of the week and even start the new week in this same spot. I don't think that's on the deck, but price can do what it wants, right? So if we can get back above the cog line, 37.11, and break through our own high, we've got a nice shallow area with nothing else in our path until around 37.80. And then we would expect some form of volatility resistance or volume resistance sitting up at that level. And I say expect because, I mean, look how we moved through this. It's pretty amazing how we were able to move through there without getting all tangled up in that trash. The point of control is still a long ways off, 38.70. It's 170 points from our current location. It's basically double our ADR. So technically we could get there, but it would be really extreme if we were to get there today because half the day is already done, right? I mean, if we were talking about this last night at 7 o'clock, I'd say, oh yeah, that's a lot more doable. But now, Nah. That, I would say that's least likely scenario. All right, so we got the volume profile here for yesterday, and you can see those volume zones. Now, one thing that we can't do is I've got the TPO loaded here on the far right, and I can tell it to read what's going on right now in our own Globex, and or I can tell it to read all of this Globex plus what we had yesterday. But what I'm not able to do is just look at yesterday with that TPO unless I turn off the volume profile that's on yesterday. And it might be worth doing that. Something to consider for a little bit later in the day. Like this very large volume area here around the 3700. Looking at that volume profile there, I would be curious about how much time we spent there, right? Because that's really what we're trying to identify. Large pools or large orders or large liquidity. If we spent a very, very small amount of time there and yet we built a lot of volume there, it shows that we were filling a lot of contracts or a lot of transactions at that location, right? Becomes like a volume node, N-O-D-E. There's no point of control to carry forward that hasn't already been touched. So there's no, you could bring forward the value area high and the value area low. Maybe the low would have some value, perhaps, but I would already be marking the low. So it wouldn't really do me any good. And I would already be marking the high, so I wouldn't want either one of those. There is some untouched point of controls overhead, but they are a long ways away. Oh yeah, forgot I've been working on a new history, so there's none there. Coors has a new product this morning. Didn't seem to help their price in the pre-market. Just checking rate changes. Bum, 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 bum. Apple and Tesla have been the last two holding up the market. And if we start to lose those two, we're really going to see a significant change in market All right, so crude is up a little bit this morning. Apple and Tesla are down. And I'm not really seeing no financials in there. Netflix, what you got going on? All right, so we have one name in the NASDAQ that is up at least 0.5%, and it's ketchup. Everybody loves ketchup. For the S&P, names that are up at least 0.5%, it's Duke Energy, just one name. So obviously, there's nothing bullish going on out there, right? And we should already know that, looking at the way that the NASDAQ and the ES are positioned this morning. But generally, the monsters of tech dominate the market, right? And what you want to be cautious of is those periods of time when they're not dominating the market. So it's always good to see if there's anything going opposite of the regular move in the market. The ES and the NASDAQ are down. What's up if they're down? Or if they're up, then what's down, right? What's opposite of what they're doing? So let's take it the other direction. Things that are down this morning. We've got the ES, and the benchmark that we're using is 0.5%. How many things are down at least 0.5%? 39. So 39% of the S&P 100 is down this morning 0.5%. That's not too bad. We've seen bigger in the last 2 weeks, right? We've seen this in the 60s, and so this is a little light. And down 1%, 16. Now, 16 is not a really big number, but it's the names that are in here that gets my attention, because these are monsters of tech. I see Amazon and Tesla and Apple and Nvidia, and those are the monsters. Meta, so Facebook is on there. The monsters of tech are down this morning more than 1%. Where they go, the market goes. They can be counteracted by the rest of the market, but only to a small point, right? And it would take an absolute rip, like in everything else. And even then, I think it would just stop us from falling, not necessarily cause us to rise. Now, over the last week and a half, we've been seeing tech versus finance instead of tech and finance. Yesterday, that rally to the upside, that was tech and finance. That's what happens when you put those two together instead of watching them fight each other. Right now, this morning, I would put a lot of my effort and attention into keeping track of what's going on in the monsters of tech, specifically Apple and Tesla, because if we lose those two, oh boy, that JP Morgan collar of 35.86 is most definitely on the table. So this is for the S&P 100. I don't see a lot of financial names in there. I know, PayPal would make you believe perhaps it's financials. It's not. So let's go look at the NASDAQ. 0.5%, 42. So 42% of the NASDAQ is down 0.5%. It's pretty widespread. Would take it all the way, 1%. 25% of the NASDAQ is down 1%. It's a pretty good size number. Some China names Baidu, got some chips. Definitely Tesla, Apple, Nvidia, Amazon, Facebook. Those are our monsters, right? So one way to look at those monsters easier is their market cap size. So we're in the S&P 500. Set this to pre-market change percent. We don't really need to mess with any of the sectors, but we do want to use the filter because we don't really want 500 names, right? We want to knock that down to about 100 names. It's really hard to get 100 on this thing, so I just try to get close, like around 110. It'll do, right? From that point, we just want to change the color scheme a little bit, making it react sooner. That's the only thing we're doing with the color. The big boxes represent companies with a large market cap. The larger the market cap in relation to names around it, the bigger the box. Simple, right? Nothing to it. What it allows you to do at a glance is see all of the market. Like right here, we're looking at basically the S&P 100, and see how the monsters of tech fit in with their peers and in the broader market all at a glance. Pretty cool. I used to hate these when I was new. A heat map. I thought a heat map when I was new to trading was the stupidest thing you could ever use. Like, who would ever use this? It was worthless. Yeah, it was worthless to me because I didn't understand any of its value. It's actually a really quick and easy way to see what the hell is going on out there. And it doesn't hurt your eyes like staring at a bunch of watch lists. Man, that made me sound old. Apple down 2%, Google down 1%, Microsoft 1%, Nvidia 1%, more like 1.25%, Tesla 1%, Amazon 1%. This is not what we would want to see, right? Even if the rest of the market is trying to stabilize and hold its line, without these, it's not going to work. I'm not seeing any sector, say like offense versus defense, that's offering us anything at the moment. Right now, this is the S&P, so let's flip it over to the NASDAQ. We don't need to apply the filter here because it's already 100 names. We could make the colors pop a little sooner, and it stayed on pre-market, so I didn't have to adjust that. The size of the boxes are exactly the same. The reason for the size of the boxes is exactly the same. We started to get a little bit of pullback in the dollar yesterday. We're at a multi-decade level of resistance, so it stands to reason that we're going to chop around a little bit there. 115 had been the target for a while. The new target is 120, and beyond that, the next target is 125. Still seeing that this is not going to slow down anytime soon for a whole host of reasons. One of them being that this is not just the US dollar, right? When you're looking at the Dixie, the DXY, you're looking at an aggregate of national dollar, right? It's not just ours in there. And with everything going on right now, most debt in the world is US debt. And if you have one nation paying another nation, they're going to, more often than not, do it in our dollars. With everything going on out there, the dollar is being bought up more and more and more. The reserves that most of those other nations are holding, they're already out. They've run through their reserves, and they're buying more dollar. That's going to drive it up more. We're not done yet by any stretch of the imagination. 115 was just the consolidation period. Benchmark, if we say get below 110, then you could look for a more sustained pullback. because obviously, you're going to get some pullback just like you did here, just like you did here. It's what a market does, right? So a little minor pullback there. We could get a deeper pullback from our current location to around that 110. But if we break beyond that 110 to the downside, then we're probably going to get into, say, the 106, possibly even back down to the 102. But it would still just be a pullback. We're in no way thinking that we're done with a dollar moving like this. So if you're looking for an opportunity, there is that. You can trade it through the UUP. I hate that ETF, by the way. I always get assigned when I trade it. But you can also use the Smalls Exchange. They have a dollar over there too. That is absolutely right. Someone said our junk is better than their junk. Yep. Um, I know where that phrase comes from, and that dude is like one of the smartest people I could name. And he's funny too. The rejection on the 1 is still holding momentarily. The expectation is this is not going to be the rejection. Price target is 7.4 and then 7.42. That's not a daily or a weekly though. I think that'd be more of a weekly monthly. A little bit of concern here with the MACD pointing up like that, looking like a SpaceX rocket ship. So, got to have a little bit of an expectation that that's going to pull back. I mean, that's like classic definition of what parabolic looks like, right? So have maybe a little bit of expectation it might digest a little bit more, or pull back, consolidate, chop around. And if you're thinking, who cares? Forex has a lot to do with so much, and depending on which pair you're looking at, it can be correlated into gold or into the energy market. So when you look at something like U.S. dollar Canada, for an example, that's a great proxy for energy. Or if you're looking at U.S. dollar China, it's a great proxy for, say, commodities. Um, it's so much more than just currency, right? Out of everything that I've learned, FX was the last thing on my list because to me it was the most unapproachable thing to learn. Right? There's so many different paths to take, and there's so many correlated states that go with it that I thought, well, I'll just save that for later. I'm glad I did because there's a whole lot to learn in the meantime. But the more I learn about them now, the more I wish I had learned about them sooner, just because of how much it correlates with other market states. And that correlation helps you understand a lot of the moves that are happening in the market. Maybe not enough to be able to anticipate moves, right? Because that would be the best of all worlds, being able to anticipate the move rather than understand what happened afterwards. But I still get a lot of trades from understanding what's going on, even if I can't quite necessarily anticipate what's coming next, right? Life goals. So a little move up in crude. That hurricane, one of the things you want to keep track of with that hurricane is it going to disrupt supply, right? Remember, it's all about like the refineries, strategic oil, petroleum releases, and then supply demand. So it's not just, oh, we had to shut down rigs in the Gulf, and that's a very, very small part of it. It's the other side. The bottleneck has been refineries for a while. So watch the NY Fang. If the monsters of tech are the albatross around the market's neck this morning, it's going to again today be tech versus finance. If finance joins this downward move, we're in for a world of hurt. If we go back to tech versus finance and finance is actually trying to hold the line, it's not enough, but it's a good start. We could see the market maybe challenge the lows without breaking new lows. But definitely keep your eye on the monsters of tech, and it's a simple ETF, NY Fang. It doesn't necessarily have volume to it, right? Because it's not a real thing. It's an index, just a bunch of names thrown together like an ETF. So you can't apply like VWAP and volume controls and things like that. But it's still a symbol to look at, right? It's a great indicator, and that's how I use it, as an indicator. Another tell or a warning or an early warning alert, kind of a heads up. Watch that Bitcoin today. If that sucker starts breaking hard and fast in one direction, that'll be a heads up, a warning. Obviously, the dollar, we've been using it that way. Look at the move yesterday, right? That thing just like fell out of bed, and it was a great tell to continue to run long yesterday. So flip that sucker around the other direction, you start seeing that dollar rip back up, especially above the Globex high of call it 113.75. That's going to be another point of direction, right? The S&P, NASDAQ probably going to start heading to the downside. Watch stocks and bonds. They start moving in the same direction like we've had this morning. Get a little nervous. Notice we have that failed. It's not a failure yet, but we have that flag here in bonds. And we have that same flag here in stocks, right? Whether we just use the S&P and the NASDAQ, call them stock. So stocks and bonds are both moving in the same direction this morning. Watch for those to decouple. And by decoupling, I mean, say bonds are still in one spot and the S&P and NASDAQ start running, or the S&P and NASDAQ are in one spot and the bonds start running. Look for one of them to go up and the other one to go down. Look for them to decouple. The VIX really hasn't been all that useful, but it still counts and it's still a part of what's going on. So, definitely want to keep your eye on it, especially since we're still in backwardation this morning. And I just can't stress it enough. Guys, be very careful. There's a lot going on, and if you only trade like S&P or SPY and you're not really looking around at everything else that's going on, you might not understand the gravity of how bad things could have got this week. But it was pretty scary, right? And it's not technically done yet. I mean, I think we're past the worst of it, but it's like a domino, right? When you line up a bunch of dominoes and you tip the first one over and it starts to cascade. It would only take one domino at this point, and the cascade would be pretty nasty. So watch your levels, make some money, right? We should get some pretty good moves. So I'm certainly not telling anybody to don't stand aside and not trade. Just no swings unless you're swinging short. I certainly wouldn't try to run to the upside in this mess. If you think that we're going to get some sort of July, August rally again, let it prove it, right? There's no reason to jump the gun early. I'm talking about this kind of rally that we had here. If you're afraid that you're going to miss it, you're not. You're not going to miss it. So if we do actually start to rally back up, there's a lot of room to make, right? You're not going to miss anything. So very short duration swing longs if you're going to go long. Otherwise, let it prove itself a little bit. If you want a bullish argument, I certainly have one. This right now looks like an island reversal, which is a candle pattern. Right? That's a bullish island reversal. That's where price comes down and then gaps down, and it builds this island, and then it gaps back up. Same thing would be a bearish island reversal, right, if we were going the other direction. So right now the gap is still there. We haven't closed that gap, and that means that we could gap back up probably Monday, right? That would make sense. Close for the weekend, having never closed this gap. Run up in the overnight on the weekend and open on Monday above the gap. That would make perfect sense if you're looking for a bullish argument. But here's the reason you shouldn't go long, or my argument for why you should wait. Until this gap is closed and we're actually on the other side of it, that's a bearish gap, right? Like straight up, that's bear mode until it's resolved. So as long as that's still sitting there, I'm going to maintain my bearish posture, right? So I got for you guys. Be careful, be safe. I'll see you all tomorrow.